Hey guys, Brian here. Welcome back to the channel. And today I'm going to show you the exact strategy that I am doing to make anywhere from like $1,000 to $1,500 a week. And it's actually pretty simple because a lot of people actually talk about it. And I just wanted to break it down even more simpler for everyone else because a lot of people go into it. A lot of people try to teach it. And it goes over a lot of people's head. I've shown my friends other videos that people have done and they're saying that they still can't explain it. So I explained it to them in person, like with a whiteboard or something like that. And they seem to have figured it out just the way I teach it. So I made a little PowerPoint and I'm going to show you like a kind of like a case study at the end of it using Fidelity. So again, this strategy isn't going to make you rich like really quick, but it is a good way to make extra income. And again, guys, none of this is financial advice, but if you really want to help out the channel, check out those links down below. Check out the free stocks. They help me out. They help me create more and more content. And this is the type of content I want to make because I like to educate. And this is one of the biggest things to do it. And guys, it's super simple. So let's go right into my desktop and let's just get right into it. What we're going to do is the wheel strategy. It is covered calls or cash secured puts. You put them together, you get the wheel. So this is going to be the simplest way I could teach it. We're not going very in depth with it. We're not going to go over any Greeks in this. Super simple stuff and just going to teach it how you're able to make income. I'm not even going to show you guys certain things like how to roll over anything yet, because when you start introducing too many different things, it starts getting complicated. And these are the rules to doing the wheel strategy. So you should only use this strategy with stocks or companies that you want in your portfolio. And I got to reiterate that. Only use this with stocks or companies that you want in your portfolio. If you could see the stock being in your portfolio for the long run, that is one of the ones you want to use. Next, you need money to make money. So you need 100 shares of that company or enough cash to buy 100 shares. So again, you need money to make money. Next, you actually need to have level 1 options enabled. Very simple to do with Fidelity, Robinhood, Webull, TD Ameritrade. Super easy to do. You just apply for it and usually get it within like a day or like 3 days. And again, since we're doing options in this, we are only on one side of the equation. We are only selling options. We're never buying. We are only selling in this strategy. And then you're going to need to understand some basic option vocabulary. And I got some right here. So strike price. This is the price that you're going to buy 100 shares or sell your 100 shares at. Next is expiration date, the date at which the option will be exercised, meaning you'll either buy or sell the 100 shares or be considered worthless. Call, the option play that gives you the right, but not the obligation to buy the stock at a specific price at a specific time. Put, the option play that gives you the right, but not the obligation to sell a stock at a specific price by a specific time. ATM for the acronym is at the money. The strike price is pretty much right at the current price of the stock. OTM is out of the money, a little bit further away. Pretty simple. Premium is the current market price of an option contract. To simplify that even more, that is going to be the income you're going to receive for writing this option contract. So that is the money you're going to get directly into your account once you put this option out there. Look, vocab continued. These are the things that we're doing. Covered call. When you have 100 shares and you use these 100 shares as collateral for the option play. Cash secured put, when you have enough cash to buy 100 shares for this option play. So covered call, your collateral is 100 shares. Cash secured put, your collateral is the cash worth 100 shares. Super simple. I'm hoping that you guys are following along. And then this is the wheel strategy. The goal is to collect premium. That is income. And you can get this every week and you get it right when you write the contract. So this involves selling a cash secured put, purchasing a stock when or if this put is assigned, and then selling a covered call against this stock. And then both the put and call are sold at out of the money strike prices. So the wheel works best in bullish markets, but again, you could do it in almost any market. And if the stock is actually trading sideways, that is actually better for you because you kind of could predict where it's going. But in my opinion, it is best owning the stock outright and then doing covered calls first, because I believe you could collect more income as well as capture the appreciation. But I actually started on the selling put side. So that's where we're going to go first. Selling cash secured puts. So again, this is usually my starting point. having enough cash to buy 100 shares. So you're going to have to pick a strike price below the current price of the stock. So put, you want the stock to go down. Put, down, call, up. So the bid ask spread is pretty much, you multiply this number by 100 to figure out your premium. You're going to figure out the amount of money that the market is going to pay you for writing this contract. So again, the goal is to pick a strike price that you're okay with buying this stock at. And again, because it's a put, you're okay with buying it at lower than the current stock price. And then if it doesn't hit your strike price by the end of the week, by that expiration date, you got to rinse and repeat this each week, collecting your premiums. If it doesn't hit, that means all the money that you put up for collateral to buy those 100 shares at that certain strike price gets put right back in your account, and then you can do it again on Monday. If it does hit the strike price, that is when that money that you put out there as collateral will end up buying 100 shares at that price that you chose, that strike price, and then you would move on to selling covered calls. Then you'd go into that other side. And that's where we're going to go into right here on the next slide. So selling covered calls. You now own those 100 shares of that company. Now what do? Now you want to make money on it. So you have to choose a strike price above your cost basis, because you're doing a call, you're selling a covered call, you have the 100 shares, you want to pick a price above your cost basis. Say you bought it at $100, that was your strike price. You would choose anything above $100. And why is that? Because you want to also make a profit when selling, as well as collecting premiums. Pretty much you want to double dip on this. So here we are in the next point. Choosing a strike price should also be a price that you are willing to sell your 100 shares that you just got. I personally choose $4 above its current price. And the reason why I do that is because if it's like a $100 stock, it's pretty hard to go up or down 4% in a week, generally speaking. So if the price of the stock goes past your strike price, you will be forced to sell your 100 shares at that chosen strike price, and then you would be moving back to selling cash secured puts. Just to put that into context, so say you chose it at 104 because we chose something $4 over the $100 per share. That means you made $400 on appreciation and whatever you collected during the premium. So now your account just has a whole bunch of cash, and then you just go right back to selling cash secured puts. So let me bring up my Fidelity right here. And how could I make this look a little bit bigger for y'all? Like that. Here we are. So I personally do this with Tesla right now because it's giving you the most money. You could do it with other things, and let me just refresh this just in case I logged out. But here we are. So Tesla currently sitting at $196.81, right? So how do you get to this? This is called an option chain. So you just click on option chain wherever you're at. You just look for it. You'll see option chain. That'll bring up all these dates and all these strike prices. So the middle, this is always going to be the strike prices. You're going to see all the dates, the expiration dates. So what we talked about, calls, puts. So remember, since we have the cash to buy 100 shares, you're going to base it off of the strike price. So if you want to do this at $185 for the stock of Tesla, you would need $18,500. So you would need that in cash in your account. So again, you can do this with other stocks that are a little bit lower. PayPal, Google, Amazon, they're all around the $10,000 mark that you will need. But I personally like doing it with Tesla because you could get the most premium, and I'll show you why. So $185, that is around $11 from its current price. So what you would have to do is, because we have the money, we're going to be on the put side. So you're going to look at the bid and ask. So you're definitely going to get the bid. So if I write a contract for $185 by February 10, which is the end of this week, Friday at 4 p.m., you're going to get $132. So how do you get the 132? You do the bid times 100. Pretty much you move this decimal point 2 spots, $132 for this week. And again, since I'm recording this on a Wednesday at night, this goes down the closer you get to the expiration date. So in the beginning of the week, I chose this and I got around $540. So if you do this on a Monday or Tuesday, you are going to get a significantly higher amount of premium. But also if you go closer to the price of the stock, 196 is the current price. So if you choose 195 or 192.5, you're going to get anywhere from $345 to $450 right when you write this contract. And as long as it doesn't hit this strike price on Friday by 4 p.m., all the money that you put up for collateral shows right back in your account. You get to always keep the premium, and then you get to bring back all the cash, and then you do this again next week for February 17th. And then you could look at this again. Look, 190, you could get $600. You get 505 for 187.5. At $185, you get 420. If you go really close, you get 700 off one contract. So again, you could see how much money you guys could be making if you have the cash to do it. So again, if you have the stock now, you will end up being on the call side. You're going to be covered calls. So what you would have to do is choose a strike price above 196.81. So 197, anywhere up to 207. And then again, you would look at the bid ask spread right here. The bid is what you're definitely going to get. You could always ask for more, but is it really that much of a difference, like 25 bucks kind of thing? So I would usually do, like I said, $4 above 196. I'd probably pick the 200. I would get $420 right when I write this contract right into my account. And then if it doesn't hit $200, my shares stay in my account. I do this over and over again until the actual price hits my strike price. My shares would be taken away from me, and then I go back to the put side. And then I would continue doing this over and over and over again throughout the years. And that means I'm just collecting income. So say I chose the lowest end here on the put side, $132, and you do this every week for 52 weeks. That's $6,864. And that's probably going to be some of the easiest money that you're going to be making. And again, this is significantly lower because we are so close to Friday. If this was a Monday or Tuesday, these prices would be a lot higher. But say you got what I got of $480 in the beginning of the week, and you could times that by 52. That's $24,000, $25,000 in a year of doing this. And that is just off one contract. So I'm personally doing this with about $60,000. So that's around 3 to 4 contracts. So you could do this like 480 times 3, 480 times 3. Actually, let's do it more conservative. 400 times 3. Like I said, $1,200 a week, and you times that by 52, $62,400. That is a lot of money that could be made. And like I'm saying, I'm only working with like $60,000. That is like 100% increase over a year. So you're pretty much making 4% every week, 16% on the month, over 100% on the year. Again, this doesn't work all the time because depending on volatility, these premiums are based off of volatility. So that's why I choose Tesla. You choose tech stocks for this. But again, you have to choose a stock that you want in your portfolio. And that's what makes it amazing, because I want Tesla in my portfolio, and that is what makes it so nice. So again, guys, this is that simple strategy of cash secured puts and covered calls, the wheel strategy. I just showed you. Technically, I can make around $63,000 over a year as long as the market stays like this, and you just keep going back and forth between cash secured puts and selling covered calls, and you pretty much just continue to collect the premium, the income off it. And if you want to know tax implications on it, it's going to be counted as income. That's really it. And it's actually super simple. And guys, comment down below if you have any more questions, if you want me to go over other strategies. But to be honest, this is the simplest one. I hopefully made it as simple as possible for you. And guys, again, drop a like on this video, share this with anyone that you think it would be worthwhile sharing to. Peace.